Topic examines the uses, benefits, and risks of derivatives in financial markets. Derivatives are contracts whose values depend on underlying assets, interest rates, currencies, commodities, or market indexes. These instruments are widely used by corporations, financial institutions, governments, and investors to manage financial exposures and improve portfolio efficiency. Common derivatives include forwards, futures, swaps, and options. Because derivatives allow participants to transfer risk among market participants, they play a critical role in modern financial systems. Understanding how derivatives function and the risks they create is essential for evaluating investment strategies, risk management practices, and financial market stability. One of the primary uses of derivatives is hedging financial risk. Hedgers use derivative contracts to reduce exposure to unfavorable changes in prices, interest rates, exchange rates, or commodity values. For example, an airline may use fuel futures contracts to lock in future fuel prices and reduce uncertainty regarding operating costs. Similarly, multinational corporations use currency forwards or swaps to manage foreign exchange exposure arising from international operations. Financial institutions frequently use interest rate derivatives to stabilize borrowing costs or asset returns. By transferring unwanted risk to other market participants, derivatives improve financial planning and reduce earnings volatility for businesses and investors. Derivatives are also widely used for speculative purposes. Speculators seek to profit from anticipated changes in market prices without necessarily owning the underlying assets. Because derivatives often require relatively small initial investments compared with the value of underlying exposures, they provide significant leverage. Leverage magnifies both gains and losses, making derivatives attractive for traders seeking enhanced returns from market movements. Futures contracts, options, and swaps allow speculators to take directional positions on interest rates, equity markets, currencies, or commodities efficiently. Although speculation increases market liquidity and supports price discovery, excessive leverage can amplify financial losses and contribute to market instability during periods of extreme volatility. Arbitrage represents another important use of derivatives markets. Arbitrageurs seek to exploit pricing discrepancies among related securities or markets by simultaneously entering offsetting transactions designed to generate riskless or low-risk profits. For example, if a futures contract becomes overpriced relative to the underlying asset and carrying costs, arbitrageurs can buy the underlying asset while selling the futures contract. These transactions help align market prices with theoretical fair values and improve overall market efficiency. Arbitrage activities also support liquidity and facilitate accurate price discovery across interconnected financial markets. Consequently, derivatives play an important role in maintaining consistency between spot markets and derivative pricing relationships. Derivatives provide several important economic benefits beyond risk transfer and speculation. They improve market efficiency by allowing investors to separate and trade specific types of risk independently. Market participants can customize financial exposures more precisely than through direct investment in underlying assets alone. Derivatives also enhance liquidity by increasing trading activity and broadening participation in financial markets. In addition, derivatives contribute to price discovery because derivative prices incorporate expectations regarding future economic conditions, interest rates, inflation, and market volatility. By enabling efficient allocation and transfer of risk, derivatives support capital formation, investment activity, and economic growth across global financial systems. Despite their benefits, derivatives also involve significant risks that require careful management. Counterparty risk is particularly important in over-the-counter derivative markets because one party may fail to fulfill contractual obligations. Exchange-traded derivatives reduce this risk through clearinghouses and margin requirements, but OTC contracts may expose participants to substantial credit risk. Market risk also remains significant because derivative values fluctuate with changes in underlying asset prices, interest rates, or volatility. Since derivatives frequently involve leverage, even small market movements can generate large gains or losses relative to the initial investment, increasing the potential for substantial financial distress. Operational and liquidity risks are additional concerns associated with derivatives. Complex derivative structures may require sophisticated valuation models and risk management systems, increasing the likelihood of pricing errors or inadequate risk assessment. Liquidity risk may arise if market participants cannot close positions efficiently during periods of financial stress. Certain customized OTC derivatives may trade infrequently, making valuation difficult and reducing market transparency. Legal and regulatory risks also exist because derivative contracts often involve complex documentation and jurisdictional considerations. Inadequate understanding of derivative exposures has historically contributed to significant financial losses for corporations, financial institutions, and investment funds during periods of market disruption. Topic ultimately demonstrates that derivatives are powerful financial tools offering substantial benefits for hedging, speculation, arbitrage, and portfolio management. By enabling efficient transfer and customization of financial risk, derivatives enhance market efficiency, liquidity, and price discovery across global financial systems. However, derivatives also introduce important risks related to leverage, counterparty exposure, valuation complexity, and market volatility. Effective derivative use therefore requires strong risk management practices, careful monitoring of exposures, and thorough understanding of contract structures and market dynamics. Mastery of derivatives concepts is essential for investment professionals seeking to evaluate financial strategies and manage risk effectively within modern capital markets.